Hello and welcome to the paid weekly recap for the week ending March 6, 2026. I'm Keith Harwood, CIO of Yellow Tunnel, and also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel and the creator of the artificial intelligence behind the paid system. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for education and information purposes only and should not be considered trading advice. And finally, myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. I also urge you to read characteristics and risks of standardized options available at the highlighted link on this page. If you need more time with the disclosures, please go ahead and pause the video now. Otherwise, we'll get into the recap for this wild week. Now, the 10-year yield rallied up quite aggressively. We had high inflation last Friday. Then over the course of this week, we had tensions escalating on the geopolitical front with Iran. This led to concerns over further inflation and higher interest rates and lower markets. The market tried to fight back to start the week. Monday starting weak and then bouncing back. Tuesday starting weaker and then bouncing back. Wednesday looked actually almost positive, like the bottom was in. And then Thursday, Friday, and then coming into the beginning of this week, it looks like we're going to start off on a weak note again. This market is not ready to call this a bottom because the market is understanding that the tensions are not easing. The US demands unconditional surrender. Iran says no. And so we are left at a spot where it escalates and escalates until someone gives up and yields. Will that happen this week? Unknown. Will it happen in a month? Unknown. Right now, all we know is it's not happening yet. And until it does, the confidence of the risk-taking community, the investment community that looks to take risk, is currently a bit worried. There's not a lot of appetite for that risk, and if there's not a lot of appetite for that risk, the market has a potential to go into that falling knife liquidation mode. The Nasdaq has actually been surprisingly strong this week on a relative basis, and a lot of this seems to be driven by positioning. Tech has been sideways. Tech has been underperforming for the last few months. And so the positioning doesn't seem to be overly on the long side. A lot of that reduction of position had already come in here in the Nasdaq, and there are certain tech sectors that are expected to benefit, from the geopolitical tensions. Small caps, on the other hand, look particularly weak. Financials are very weak. Even healthcare, which is somewhat of a safe haven, weak. And as we see that there had been some money flow into these small cap names, especially relative to tech, peaking out in January, looks like there's more room for this to fall because the positioning is longer. So if there are more long positions here that need to move, they're doing so. And small caps, as a result, underperforming. Now, on top of all this, we got the highs of the VIX for the last 6 months. We tested out 30 on Friday. We'll be higher on Monday morning. So with an elevated VIX, it's a very difficult market to get too aggressive in positioning. This past week, we held off on the paid trades as a result. An elevated VIX, 20 plus, potential to go into major fear mode. I'm not looking to buy that market. If I sell a put credit spread, I have a high probability or higher than usual probability of achieving a max loss. If I buy a call and the market just simply bounces back lightly, I paid for a very expensive option with the elevated VIX and need a big move to the upside. And if I don't get a big move to the upside, I am out a lot of money. And if we get a move to the downside, I'm out a lot of money. So there's not a lot of scenarios where the bull wins in the current marketplace. And since our signals in paid are driven from the long side, they really need to be capturing moves in stocks that are moving to the upside. Whether it's a fertilizer company like CF that was positive last week, or some of the energy companies, not all of them were positive last week, but some of them were. Problem is, a lot of those moved over the weekend with the update in the geopolitical news, so that Monday morning they had already started to run a bit too aggressively. And at any point, that geopolitical tension can fall and completely change those bullish stocks into bearish stocks in a bullish market. And so all of that said, last week, no trades this week. We'll see how things go. If the geopolitical tensions start to subside, we may look at some trades later in the week. Unlikely on Monday, perhaps on Tuesday, but frankly, more likely than not, if we're going to be getting into a trade, it's going to be late in the week. We are still talking through some great ideas in live trading. A lot of good earnings trades out there still. And we've seen some good earnings trading opportunities, as well as some other names that can be traded in a shorter term, maybe a 2-day holding period rather than a week-long holding period, or longer term investment type trades. There are good trades still out there. They're just maybe a little bit different from what we've been looking at recently for the paid type signals. So, we'll continue to monitor for it because they are consistently there. We just may have these 1 or 2 week reprieves due to fundamental inputs coming on a geopolitical landscape. All right, folks. With that, if you have any other questions, you can always email me. I'm Keith at yellowtunnel.com. Vlad is Vlad at yellowtunnel.com. We're always happy to answer any questions you may have. I'm looking forward to what's looking to start off as a very interesting week and may turn into a great buying opportunity if something shifts on the geopolitical front. Thanks again.